All right, it gives me great pleasure now to bring on board Rashi Talwar Bhatia, partner and portfolio manager at Ashmore Investment Management India. It's her first time, at least I'm interacting with her. So Rashi, a very warm welcome. Nice to have you on ET now.
It's nice to be here. Thank you.
We started the year with the assumption that the market valuations will get challenged. We started the year with the assumption that economy will bounce back. We started the year with the assumption that global noise would be high. So can I say that markets so far this year are moving as per the script, volatile, noisy environment, and creating a lot of confusion?
Oh, yeah, you can say that. And that may be, partly correct so far. But I do believe that the kind of bounce back we've seen in March really didn't make sense to me. So there will be odds and ends which will, I guess, catch us all off guard. But we knew that it's going to be a difficult year. And I think from that perspective, uh, uh, yeah, we should brace for that.
What will be the biggest moving part according to you for rest of the year?
According to me, the biggest moving part for the rest of the year is going to be what happens to domestic liquidity and as a result to credit growth and therefore uh, earnings growth for companies. We've been in a liquidity deficit scenario for far longer than what should be natural for an economy like ours, and RBI is aware of that and has tried to do multiple things, but it has not really helped. And we are in a situation while large cap earnings have been moderated and I think are a little more realistic. 1 year forward earnings for the small and mid space or projections are still not in the zone where I feel they're comfortable. I think they need to get cut further. And as that happens, I think how the whole system adjusts to that. So the economy trudging back to a decent growth because RBI has to fuel the system, and earnings getting cut from that side with some more correction in the small and mid cap space.
So before we get into specifics of India, I'd like to draw your attention to what's happening in the world. And one would say that both India and US are at the opposite ends of spectrum. So in India, growth seems to be bottoming out, in US, growth seems to be topping out. So how do you see the interplay impacting financial markets, and especially India, when things in India on the margin are improving, things for the rest of the world on the margin could deteriorate?
Because again, it comes back to the fact that we are mainly a domestic economy. We do have some exports and some interface with the global world, but it is not as much as, let's say, a lot of other economies, right? So from a domestic perspective, for the next 2 years still, you can very well say that a lot of the growth is going to be driven by the domestic economy. Therefore, it is very important what happens to the Indian consumer. What happens to credit growth in India? 60% of your GDP still comes from consumers. Consumption.
Okay.
So I think from that perspective, I'm no expert on the US, but all the noise on tariffs, all the noise on everything, I think at least as far as I'm concerned, we will know tomorrow, one way or the other. Hopefully, there is some clarity to all the noise on that front. And really, that's when we factor it in and move on, whichever way we have to. It's the uncertainty that is more painful than the actual reality of what comes in, because then you can factor it in and move on.
A bit more about your investment style. I mean, there are investors who look at price to book, there are investors who look at value, there are investors who look at growth. At Ashmore, the funds which you manage, in what category would you like to categorize your style of investment?
So, Nikunj, we do not fall into either the growth or the value style of investing. And that's specifically the fund managed by me. So we look at bottom-up investing and stock idiosyncratic risk or stock alpha. So if you look at a market, you will see risk-free return, you will see the market beta, and then you see the stock alpha. So we basically build a very high concentration, high conviction portfolio where we see price dislocations in stocks, and volatile times are actually great hunting grounds for us because it is during volatility that we start to see price dislocations where sometimes the market overreacts to maybe an event or just factors such as overselling, and you get a stock where the price is dislocated and you get it at a really good not value but difference to where the intrinsic value should be.
So how does your whole investment process start? Do you stumble on the mega trend and then look at the best company within that mega trend, or the mega trend doesn't matter as long as the company is growing irrespective of the sector or the theme it is in?
Well, both matter. But if you were to ask me to break it out in to percentages, it would be 70% bottom up and a 30% top down. But from how does the investment process start? It is very structured. It is very process oriented. It is actually sitting every week and looking at your focus list, which would be 250 to 300 stocks of the current market, which is where good businesses that we would like to own at some point of time that have a right to win, and seeing where we get price dislocations. Like I said, that could be because the stock price is reacting, but we're not seeing earnings growth move down or get consensus earnings growth get cut, or we believe consensus earnings growth is getting cut far more than where it will actually come in because our numbers are higher. So it could be anything that leads to that kind of a dislocation, and that would be a good time to start looking at those stocks.
So in the market, where do you see a combination of earnings growth and P multiple re-rating in next 2 or 3 years? Where are you picking spots where earnings could be 15% plus CAGR for 3 years, and there could be a mild amount of P rating?
So again, I'm not really specifically hunting for a 15% plus earnings growth CAGR for 3 years, right? That's not what my view in terms of what price dislocation means. But I can tell you sectors in which we believe in a year like last year, which was probably is a harder year for us to invest in versus a year like this year, we were picking the chemical stocks, and we saw price dislocation in the chemical names. Now, from January to now, it looks like a great place to be. But all of last year, when we were buying those names, it didn't look like the fancy place to be. So, we concentrated our portfolio last year again into the larger private sector banks. We've owned the larger insurance companies, life insurance companies for a while. And, these are the places which were not so loved last year and seem to be in a better place to be this year.
So which are the pockets right now, they may be out of fashion and markets don't like it, but you like them?
I think insurance is still out of fashion. I don't think people are looking at life insurance with any love. Even large private sector banks, I have never seen them this cheap. They're trading practically one standard deviation below their average, long-term average multiples, price to book. So those are good places to be. If you ask me, I think it's in the large cap space. I'm not seeing much opportunity in the small and mid cap space, small and far between. But I think in the large cap space, there is a lot more opportunity because with the kind of FII selling we've seen, where they've the ones that have wanted to exit have exited, you've seen them sell their large in the large cap space. So I think there the opportunity is far larger than in the small and mid space.
One space which is interesting but hard to value is this entire digital migration. I mean, we can be reasonably sure that companies like Zomato, Policybazaar, they will grow. But how do you value them, I think, is a question mark. So I just want to understand your thoughts that how are you betting on this digital migration and how are you valuing some of these so-called platform companies?
Yeah, it's a great question. I think when you value these kind of digital migration companies, you have to have a larger view on the overall trend, right? So you cannot look at, first of all, there's no history. You can't look at price to earnings or price to book. But you have to look at more broader decadal trends. So women in the workforce, we are at a point where we're seeing more women enter the workforce than we ever have before. We see, 2020 in university and now in the workforce. We're incrementally seeing more women in the workforce. Uh, that changes the structure of consumption dramatically. If a woman is out of the house for 8-10 hours a day, she's looking for ways to make life easier at home, and that could be food, e-commerce, through e-commerce or quick commerce, or she also now spends more on herself, whether it be the BPC, beauty products, right? Uh, Not just makeup. We're looking at new things like skincare. So again, these are all you know sectors which are going to grow much faster than their underlying basic staples or basic discretionary, because you have a trigger to growth over there. And these are decadal changes. 2005, it was 23% of women in the workforce, and we're now at 37 right now.
You just preempted my question, because I know that you've called out this mega trend in women in workforce inclusion as a mega theme. So I'm just going to break it for our viewers here so that they can benefit from your wisdom here. What you're saying is that, look, you like consumption, within that the time to buy good old classic staples, that may not be a good idea, but look at a mega trend which is staring at us, more and more women participation. That means they'll travel out more, they will go for more wellness, they will go for more beauty care. So BPC segment and all those categories essentially could be large, and they really could be big. Another, there are a lot of themes within themes, if I may like to call out, which of late have really attracted a lot of attention. For example, financial inclusion, surge towards power transmission, boost towards manufacturing. For a long-term investor, these trends like energy, manufacturing, power, are the real deals?
Oh, absolutely. For long-term investors, they are real deals. In our portfolio, we had a very positive view on power generation, transmission, the whole space, right? But just the history of how power generation has played out in the country and the uncertainty with contracts, etc. We and the long gestation periods that go with the power gen space, we were happier taking a position on the power transmission space or building out of power transmissions. And these are companies which have shorter project cycles, it's quicker to the market, cash flow cycle is better, all of that. So you pick in the space where you would like to be positioned based on the fundamentals of the company. But that's, I think, the reality is that there is absolute money to be made in the space.
IT, when I say IT, I'm talking about the classics here. IT services. I mean, I distinctly remember when I started my career, Infosys was a high growth company. It was growing at 100%. Today, they are struggling to grow at 10%. Given what is happening because of AI, and given where disruption is happening in terms of the productivity shifts, is IT a sector which you should avoid, or it's a sector which could spring in a surprise?
Oh, I think it's one where, it's going to be hard to bet on the sector as a whole. You have to bet on companies within the sector, and that's the real call. You're absolutely right. AI is going to be a game changer, but we all have to figure out how. And there's going to be a lot more IT services needed to get AI to work for companies or work, for industry in a way that is productive. And that means more business. But who are the winners within that, and who are the losers within that? That's the pick you have to make. And those are the companies you have to know within the sector. So again, I think it's going to be one where it's going to be, the whole sector may not do something fabulous, but you will see strong winners and losers within the sector. And that's the great thing about how markets are.
How would you approach the so-called global facing sectors? I mean, we've discussed IT, but then there is also pharma, there are exporters, manufacturing, EMS. That theme has been a powerful theme of late, at least for Indian investors. Chemical, which you just spoke about. How would you approach in general exporters now when tariffs are at play?
Let's take the pharma sector. Okay, there's been so much noise. It's a sector that's underperformed based on this noise. Let's look at US generic pharma. We are, I think, into a multi-year cycle. We've had multi-year cycles where US generic pricing has just been on the way down, and companies supplying to US generics have just been hurting. Now, if you go and put a 25% tariff on a lot of these companies, they are at wafer-thin margins. They don't have the ability to supply or absorb those tariffs, essentially. So either they'll stop supplying or they're going to pass on the price. Now, let's look at the US side of it. How much of this is manufactured in the US? Very little. I mean, how are you going to, keep the supply of your generic drugs going for the domestic economy? I'm talking about the US. If you're going to put tariffs, and then if the price increase is going to come, you're not going to take it. So there has to be some rationality towards it, right?
Fantastic. So finally, let's wrap it up with one final question. 3 years out, maybe 5 years out, if you're engaging in a similar conversation or same forum, which end of the market do you think will trade lower? Which end of the market do you think will go nowhere, almost like an HUL or Infosys return? And which end of the market could be significantly higher?
3 years out is a really long time. But if you were going to ask me 1 year out or 18 months out, let's say 1 year out, I think from here, the small and mid will still be lower, and the large caps will be higher. And that's how the market will trade.
Well, so nice to have you, Neeti, now, and look forward to a lot of interviews and much more engagement and increased participation going forward.
Thank you, Nikunj. It was a pleasure.
If you like this video, then like, share and subscribe to ET Now.